backed by popular demand, the blind stock analysis. Guys, we've done this in the past. It was really popular. They hide the numbers from me. I have not looked at the board yet. I don't even know what's behind me. We sit there and look at the financial statements. We look at everything, try to determine what price to pay. And we also try to guess what stock it is. You guys know what it is already. Mo and I do not. So here we go. All right, guys. So here it is. Let me turn around, Mo.
Okay.
All right. Revenue, 121 billion. Oof, they lost 9 billion, but had 18 billion in free cash flow. So this is something that I'm going to look at and say, okay, what kind of company would have some sort of big write-off maybe, still show amazing cash flow? I think I know what it is already. It's like literally I saw this and I was like, oh, it's At&T. Is it At&T? Yeah. The second I saw that, I was like, oh, it's At&T. Okay, so guys, I got the stock, and I want you to keep in mind, the first time we ever did a blind stock analysis, I got it right, and this time I got it right. Every other time in the middle, I got it wrong. So just happened to catch it, and the reason I knew this was I remembered about how At&T was showing big differences in cash flow versus net income. I just remembered that over the time, and I was like, okay, and I look at this price to free cash flow, thinking to myself, now, they also gave me a hint. When they said the market cap and the enterprise value, I would know it the second time I saw it, and these were blocked out. But the second I knew that that was the case, I was like, okay, it's At&T. So let's sit here and go through At&T stock because, guys, it has a very big dividend, 8%, and that can be very appealing. But you've got to remember, what are you laughing about?
He shouldn't be paying an 8% dividend. That's the funny thing.
Why do you say that? Because you're 100%. I agree with you 100%. Why do you say that?
Because they have an incredible amount of debt that they should be paying off.
Yeah, so the stock has really suffered a lot lately, Mo.
And that, to me, is the reason that they won't cut that dividend.
They need to give people a reason to buy the company, right? Guys, the issue is, man, this debt level, guys. So let's look at it this way. We have a $100 billion market cap. We have an enterprise value of 382. What this difference is essentially the net debt on hand. So you take the cash off, add the debt, et cetera. So there's $280 billion of debt on this company. They do $120 billion in revenue. And even last year's free cash flow, they're still selling for 12 or 13 times their free. They still have 12 or 13 times net debt versus their free cash flow. Guys, debt is a very scary thing. I'm not opposed to debt, but I'm opposed to massive amounts of debt. When companies get into trouble, it's when usually times go bad and there's a lot of debt. So let's look at some numbers just overall.
If I'm not mistaken, they've sold off some debt, haven't they?
They transitioned debt off as they, yes, correct.
That's right.
As they spun off the companies, and because last year they spun off a bunch of their Warner Media or whatever it was. But let's go here and look. Long-term liabilities alone, $236 billion. Okay. Plus $15 billion of current portion of long-term debt. So look how $250 billion of debt. Can anybody, Mo, can you find out, or Dalton, can you find out what's their average essential interest rate on their debt right now, on these long-term liabilities? And the reason I'm asking for that, guys, is let's say hypothetically, and we'll get into it in just shortly when Dalton finds it. Let's say their debt is 4% because rates have been so low. Well, what's happened to rates in the last 18 months? They've skyrocketed.
Relative to where they were.
So if before, when rates were 0%, they were able to borrow at 4%, what do you think is going to happen when $250 billion in debt gets refinanced in a few years at even 6%? That 2% difference decreases their cash flow by $5 billion a year. That's not something to sniff at, considering they pay $8 billion a year in dividends. They're going to have to come up with this money somewhere. And I look at this going, man, when interest rates are low, you can get away with low debt. But when interest rates start to go up, and we don't know where they're going to stop, maybe they stop here and they go back lower, I don't know. But you have to factor in the potential for the long-term liabilities to be refinanced at a much higher rate, especially with so much debt. The debt is, I'm not going to say crippling, but let's look at this company's growth levels. Well, I mean, I just look at the income statement. They've spun off divisions and things like that, but it hasn't gone the right direction.
Yeah, so now they're...
And look at this big write-off they had, $21.9 billion.
Yeah.
$21.9 billion. That's what led to 8.77. So even then, they only had $13 billion in net income.
Okay, so they have these lead cables that they've been using, and they are transitioning to a safer material that's more EPA friendly.
How much is that going to cost?
as of right now, they're estimating $4 billion, and they've been spending already like crazy on these things. So this is just more.
So when it
more
comes
spending, more.
yeah, and I look at AT&T and I think to myself, like, man, let's see what analysts are. Oh boy, oh my God, Mo, look at this. It's the inverse that we always see. Look at this.
Oh
So
my
these are 8
gosh.
pillars, guys. And if you have our software, you can customize this up to 12 pillars. But usually what we want to see is like green check marks all here and then the red X's here, because all we have to do is wait for price to fall. And this is a little misleading. These earnings, a lot of times, a lot of people like to go to enterprise value ratios. Enterprise value to free cash flow is 21 times. Enterprise value to 5-year earnings is 49 times. It's like that factors in the debt. And I look at this debt and I think to myself, okay, let's say they want to get rid of all this debt and they raise $250 billion in equity and write a check for all the debt off. So let's say the average is probably closer to 2026, probably 2030 to 2035. Okay, they've got some time left.
Yeah.
But if they don't start turning around the ship on free cash flow and earnings, like literally, I sit there and think to myself, maybe I'm wrong by saying maybe this is the time to be buying AT&T because everybody's taking a dump on it.
Maybe.
Maybe
they
it's time.
But they haven't really shown that they're going to do things differently to change the direction. It seems like it's just the same old same.
What do analysts think?
There's not.
Oh my God, there's no growth here. Oh, geez, oh,
there's like barely any earnings growth and barely any revenue growth.
From today to 2027, they're expecting not even a 10% increase, 8.3% increase in earnings per share.
124.25 billion this year to 131.25 billion.
This isn't even keeping up with inflation.
No, well below.
Man, this is tough.
This isn't even keeping up with the 2% target they want.
Guys, this is a tough company. And I do believe in having your buckets of my circle of competence. What's up, Mo?
I didn't realize it was $14 a share.
Oh yeah, it got to 13.
Right,
it got to 13 recently. So guys, our 52-week low is based on end of day, and we're looking at 1408. So it's basically there. Now it has been lower than 1408, but it closed above that mark. So I'm looking at this going, boy, it's really exciting, but look at this return on invested capital. I am glad they're paying a dividend for that reason. But if their average rate is 4.1%, I mean, they're actually going to do a pretty decent job by just paying down the debt. Man, I don't know. This one's a tough one. And I do believe in saying this is my too tough pile. Like for me, for AT&T, with all this debt and all these, like, yeah, if I knew the future and said they could manage the debt and refinance appropriately and at least increase cash flow with inflation, I'd say, okay, this is probably a no-brainer. But I don't see that here. I don't know that's the case here. And I just get antsy about that. I think to myself, I'd have to spend too much time watching AT&T. And that's not the kind of investor I want to be. But it could be the investor you are. And I'm okay with that. There are multiple ways to skin a cat. And for you, being the kind of investor who wants to watch your companies every month, every quarter, great. I want to buy no-brainer companies with low debt that I can just sit back, watch, and enjoy my flight. That's it. That's all I want to do. And I think on AT&T, I'd always be worried about this dividend. I don't think this dividend is going to be safe. I think at some point they're going to say, listen, we got to cut this thing. We got to cut this thing. We got to start paying down debt. We got to start investing if they can find opportunities to invest or make good acquisitions. That's the hard part, though. How often do companies and corporate executives make good acquisitions?
How often do they make good acquisitions?
Yeah, I mean, let's go look at their acquisitions on their cash flow statement. So on our cash flow statement, there's a specific line, acquisitions and dispositions. I mean, they just make tons of acquisitions here. Oh my God, this is exhausting. Listen, AT&T could be a great company to invest in. It's just out of my wheelhouse where I just go, it just makes me feel icky inside. Don't you think, Mo?
Yeah.
I just don't like all these things I have to watch and be concerned about. I just look at it saying, listen, there could be a lot of upside potential for AT&T. There could be, it could be a multi-bagger if you buy it at the right price, they turn things around. But I don't think there's any indication of that. So for me, I just sit there and say, hey, listen, I'm out. But it doesn't mean you shouldn't, that you should do the same thing. Remember, we're trying to teach a process. And there's somebody out there who can understand this debt and this situation and say, you know what, I'm comfortable with it. Or somebody who works at AT&T and says, you know what, I see what they're doing and they're turning things around and it's going great. Great. But for me, I just got to watch out for it. So guys, this is our company. This is our software. If you like it, check out everythingmoney.com. We're running a 20% off special right now. And when you watch this video, let me know what you think by following me on Twitter and tagging me. I'm very active at Paul Gabrail. I tweet multiple times a day. I interact. It's a great time. So guys, thank you very much. Appreciate your time.